All right. So over those 15 years, I learned a lot. I met few people who guided me at the right path. There are few really made the difference. So I'm going to teach you, or I'm going to show you, or I'm going to talk to you about what I do and how I provide you the trade alerts and what you can do to capitalize on it. I will show you a few charts also of my trade. Um, so see if you can figure it out, the entries and exits. So my style of trading, I have learned so many things that it has become second nature. It's easy. So it's not at all complicated. It was very complicated when I started. I used to call. There was a person named Marshall who was my instructor, and when I bought the software, and I used to call, "Hey, Mr. Marshall, is he available?" And it was like a landline. So Mr. Marshall is busy, and then I'm put on hold, and he comes back, and then he answer my question. So Mr. Marshall was my first teacher. So it was very complicated at that time. Now it's easy. So during my early days, one of my mentor named Chief, he introduced me Bruce Lee because I was all over the place. So he told me that, uh, this quote: "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." So you need to understand who you are, what you're trying to achieve, what are your objectives, and then whatever fits you, your style, because your style may be different than my style or your friend's style. So whatever fits you, you practice that style again and again till you make it perfect. So here are some points I created last night. If Bruce Lee were a trader, what he would have done as a trader compared to the wannabe trader. So I was laying in bed and I was saying, okay, Bruce Lee. Bruce Lee is coming to the ring to fight, and here's this guy, big belly, beer belly, maybe 300 pound, and he thinks just because of his weight, he can come and like they show in the movie at the bar brawl. That's what I was imagining. I was imagining Bruce Lee in the ring with this guy with a big beer belly and a big tummy and 300 plus pound. You come to the ring and then try to beat Bruce Lee, and Bruce Lee is just with one finger will be flying that guy into the sky. That's how the Bruce Lee was. So I just imagine. So the difference between Bruce Lee and a wannabe trader. So what would be? So I wrote down a few points. So uh, Bruce Lee would have mastered the basics. So first, he would have mastered the basics, whereas the wannabe guy seeks shortcuts. So just give me hot tips. That's the shortcut guy. Give me some tips so I can make some money. That's the shortcut guys. Bruce Lee would have adapted useful techniques and rejected the useless techniques which are not working. Whereas the wannabe trader, compared to Bruce Lee, would have clung to outdated methods. Bruce Lee would have been calm and focused. Imagine Bruce Lee as a trader. He would have been calm and focused, and the wannabe guy, the big belly guy, beer belly, would have been fearful. Bruce Lee said one time, "As you think, so shall you become." So Bruce Lee would have understood his beliefs, who he is, what kind of beliefs he has about himself, about the market, and about his limitations, about his strength and weaknesses. So all that Bruce Lee would have kept in mind, and then would have adopted the proper mental state. The mental would have access the mental resources, and then executed the mental strategies. Whereas the wannabe guy, the 300-pound gorilla, he would have just had a limiting beliefs. Bruce Lee would have emotional mastery. So mindset and belief. So imagine the mindset of Bruce Lee versus just an average trader. Bruce Lee would have been learning for 10 years, 15 years, 20 years, since the age of 5, 6, forever. Whereas the wannabe guy, he would have been just, learn something here, a little here, 20-minute, 30-minute, and that's it. So that's what the wannabe trader would have been. Bruce Lee would have sought inspiration from the masters and not content with the limited knowledge, whereas the wannabe guy, he is just content with the limited knowledge, whatever he can get on YouTube, YouTube or Facebook. That's where he would go, and the wannabe guy, and try to learn here, there, save money. The wannabe trader, what they do, they want to make money first and then spend money on education. Let me make some money and then I will spend some money on my education. So it's the reverse. Think about that. Make some money, and then spend money on education. So that's what the wannabe trader. Bruce Lee, if he was trading, he would have avoided unnecessary risk and not haphazard. So risk management, where Bruce Lee would have adopted a proper risk management, whereas the wannabe guy neglect all critical aspects of risk management, does not know. Bruce Lee would have adopted the proper risk management. If Bruce Lee was a trader, he would have been very patient, and timing would have been his criteria, the right timing, waiting for the right moment to strike. So if you go on YouTube, you see, I don't know who that master was against Bruce Lee. He was a champion himself, but Bruce Lee was so perfect. Even in the slow motion, you cannot detect the strike of Bruce Lee. That's how the Bruce Lee would have been as a trader. Bruce Lee would have adapted, evolved and created unique approach to trading, whereas the wannabe trader just whatever method he gets to make some money and then uh, leave the market. So that was happening to me when 15 years ago when I started wannabe trader. And on top of that, I started with option trading without knowing the market, without knowing myself, without thinking that I need to read the chart of the stock first, understand the kind of market trading, who I am, and then go into option trading. Is much deeper level. It's way, way below, whereas people try to make money from option trading. One of the thing I learned in the beginning that hunting the dinosaurs. So one of my mentors told me gave me the example of dinosaurs. He said dinosaurs are there. The big boys are like dinosaurs. They come at the right time, either to sell or to buy. So learn to detect these dinosaurs. They leave their footprints. So dinosaurs can run but cannot hide their footprints. I focus on learning few things at a time. I started one by one, and I will show you. I will explain to you some of the strategies. So it depends on what is happening in the market. Uh, so combination of all that. So imagine if Bruce Lee is fighting, and uh, he wouldn't say, okay, let's be straight. Let's set some rules so we can fight. Uh, Imagine Bruce Lee in the ring. So that's what happened when you see the chart, when you see the symbol moving, then at that moment you have to understand what is actually happening and what kind of techniques you can adopt or pull out. So master the few technique chart patterns. I will tell you which ones, and there are many others. Uh, preparation is the key. So traders don't spend time in preparing. I already prepare for the coming week. Today, this morning, yesterday a little bit, and this whole day. I prepared my list. So think about that. These are the bullet points: mastery through practice, adaptability and innovation, emotional mastery, mindset and beliefs, continuous learning. He would have been continuously learning, risk management, patience and timing. See, think about the strike of Bruce Lee. You put one finger and you fly away, and you don't even know when he put the finger or he pulled his finger. Adapt or perish. So all that, Bruce Lee versus wannabe trader. Then I was talking to you about the dinosaurs. So I was the big boys. They are like dinosaurs. So one of my mentor, early chief, he talked to me about it. So he's the one who told me about Bruce Lee. He's the one who told me about dinosaurs and many other things. So big boys are like dinosaurs. So detect you can see the footprints are there. We have to just know the right time. Where is the right time? Where which price point looks like the right time that they are active in the market. So and another thing, I was trying to learn so many things. So the criteria in early age, the criteria, if you list the criteria, what kind of criteria I need to have? There are thousands of things. So criteria should be that I need to master those chart patterns, those techniques, those trading systems, those strategies which are reliable, which fits my style, which come appear often. They're reliable. They have a proper risk to reward ratio. They don't appear once in a blue moon. If they appear once in a blue moon, then what if I miss it? Then I miss it. What if I don't miss it? I take it, and that trade turns out to be a loser. Then what will happen? So not that kind of, every day there is, you turn on your computer, you see something is there. If you have a few positions, some are moving up, you're taking profits, some are getting ready, some you're exiting, some you're just putting it on a monitor mode. So all that, then preparation. So preparation, what kind of a stock you want to trade? So I already have the basket of the stock based on all the criteria, and I prepared myself about 250 symbols. So about 250 symbols I prepared for this coming week. And also tomorrow when the market closed, then I will add or subtract some of the symbol based on what happened tomorrow. So it's a constant preparation task every day, 5 times a week. I need to prepare. So I got ready for trading tomorrow. So when the symbol is moving, I already memorized those symbols. Which symbols I'm looking to the upside, which one I'm looking for the downside, mostly to the downside. And by going through those 500 or plus symbols I have, then I prepare for 250. I also understand about the conditions of the market. So it's a bottom-up approach. I do bottom-up approach analysis, and then you have to do the top-down analysis of the market. So what is happening to the indices, and then what the individual stocks are telling you where they are. So if I prepared 250, let's say out of 250 symbols, I got 60, 70 candidates to look at. Out of 60, 70 candidates, let's say 70, 50 are to the downside and 20 are to the upside. So it's obvious that my bias is to the downside in the market. Right now, the market has put on the top, and only few candidates are moving to the upside. And the market put on the top, people don't realize it. The Apple on July 19, when I sent you if you were in my mailing list at that time on July 19 of this year, I sent you the alert that the Apple has put on a major top. It was at 198.23. And I was expecting this top in Apple long before uh, it was there. Like it was around 180, 81. So July 19, Apple put a top. It's a major top. I don't know where it will stop. It may go to, if it doesn't hold 170, 175 level, I expect it to drop at 150. And I also was telling you about the puts, etc. So that was the day when the market made a major top. Um, and market is crashing. It's not crashing yet. Market is not crashing yet. It's just a gradual down move. So my bias is to the downside, and the banks, etc., are coming down. The Caterpillar, Home Depot, Lowe's, all of them are down. So I have prepared for this coming week. So if you do the analysis of individual stock in like top 200, 250 stock, it's a pain. It's a pain to go through, but you have a better understanding of the market every day, five times a week. Now, here are some of the techniques, strategies I will go through. There are about 12 of them listed. So there's something called black box trading strategy. This is the black box I bought 15 years ago, paying $3,000. They gave me, they said, if you see the green line above the red line, then you go long. If you see the red line above the green line, you go short. What they did not tell me that they adjust the line as they move forward. If, let's say, I see the green line today over the red line and I buy, it's Monday morning, and then the stock goes down on Tuesday or Wednesday, then what they will do, they will adjust the line to the downside for the Monday and then backward. So they keep adjusting. If the stock keep going down, they keep going backward and adjust. And on Friday, let's say, the stock has gone down, and on Friday, if I'm looking at the chart, and then I say, what the happened here? On Monday, I swear I saw green line on top of the red line. Now they are showing the red line on the top of the green line. So what is that? So I did not realize it, that that's what they were doing. Now they are not in the business at all. So no wonder I fell. So that black box. So that's where when I joined the trading forum, Yahoo Trading Forum, there was one person named Randall. So he sent me email. I was very active in the forum. I was sending email and learning the way I learned SAP by being in different forum and by talking to my mentor, making list of the questions in database, and no question get unanswered. So the same way I started learning about trading. So when I put the questions that I'm trying to learn the software and it's not making sense. So Randall sent me the message and he said, call me. So I called him and he said, Noshi, this black box is like, so I was in San Diego, La Jolla, that's where I was working. So he said, imagine you're walking on the beach and you're walking backward with the broom in your hand and you're erasing your footprints. And then you reach a rock, a boulder, and you jump on the boulder and then you erase your last footprint and then you disappear. Would people find that you were there? I said, of course not, Brandon. He said, that's the way this black boxes. They adjust the line backward. That's why they teach you. They were in the seminar on Saturday morning. Those were sales people. It's all about sales. They were selling you the software. They make money by selling you software. They prepared the charts of all the green lines on the top and showed you that, hey, if you had bought leaves 2 months ago, look at this green line on top, you would have made this much money. The option was trading at this, and now the option is trading at this. Or the red line is on top of green line, and you would have bought puts, you would have made this much money. So that's the way a lot of black box work. So black box trading strategy, you can maybe there's a black box, you can trade. So, but you have to know what the assumptions are behind the black box. Another is the chart pattern trading strategy. So this is what I use, chart pattern. So chart pattern trading strategy, I will explain to you. Band trading strategy, then there is a trend trading strategies, then there's a moving averages breakout strategy, then there's a support and resistance trading strategies, then there's a breakout strategy, there's a breakdown strategies, then there is a gap up strategies, and then there is a gap down strategies, and then the gap reversal strategies. So gapping up, coming down, gapping down, going up, and then there is intraday reversal strategies for short-term traders. So many trading strategies, techniques, patterns, trading systems, indicators, and studies, and God knows what. So how do you come to senses? There's always Uh, if there are 10 ducks, and you're trying to put all the ducks together in one line, there's always one duck which is moving away. So figure it out. So black box trading, so unlocking the algorithmic trading secrets. So you develop your algorithm and automate the trading. You can do that. I have automated my exit strategies. So once I put on the trade, so the putting on the trade is visual. So for me, is visual. I need to see it and go through the rules. So I'm a rule-based discretionary trader. So I go through the list of, I see it, I recognize it, it looks familiar to me. So I see it, I recognize it, it looks familiar to me, and then I get the good feeling. So I have 4 steps behind, and then I execute the trade. Once I execute the trade, then it goes on automation of exits. So I have various exit strategies. So black box trading strategy, executing trades without human intervention. So if there is a black box completely automated, like they do have, big boys have, is without human intervention. They are going super fast. They're recognizing the pattern, and then they're entering and exiting with, while you are just moving your mouse. You are moving your mouse, and it's like Bruce Lee. You are thinking to strike, and Bruce Lee have already strike back, and you are down. That's the way the big boys are trading. So executing trades without any human intervention. So emotion, there's no emotion. Predefined criteria, complex mathematical model is super complex. If you ask BlackRock or Firm or Ray Dalio or whoever, imagine what they're doing. They have historical data analysis for hundreds and hundreds of years. All the computers, they analyze all the amounts of data. They analyze price, volume indicators, chart pattern. So this is what black box trading is, the real black box. So this is the black box. So a lot of data collection, then they have a strategy deployment and the back testing. They have tested the system in the various environments. So a lot of testing gone on, and now they are executing it. So think about the back testing. When you have done the back testing, in what market type? So or what was the criteria? So the black box, the kind of black box you see on YouTube, for $49, you buy my indicator, master indicator, $49. You put that indicator and you start making money. So that kind of a black box, ask them what kind of environment, how etc. What kind of data they had, and what kind of a market they tested. So they will select a period, uh, like that period where they made money, the trading system made money. So they will show you that data. So, but the advantage of the black box trading is speed and efficiency, emotion-free trading. So it's all automated. Scalability. If black box is making money, at 100 shares, you can trade 1,000 shares or 10,000 shares. But so there is a consistency, but there is a limit uh, to scalability. You may break the system. You may create a wave in the market if you are not. You may be the only one in the market. So scalability doesn't mean you can trade 10,000 or 100,000 shares. You can create a wave. So there's a risk management involved here, scalability, when you're doing a scalability. And but backbox is consistent. So it should be consistent in and out. So the limitations of black box, think about that. The limitation of black box is data dependent. So you need a high quality data and availability of data. So who is providing the data to your black box? Market conditions. Black box may be just trading normal, and then suddenly it just stopped to work because the market conditions change suddenly, and the black box doesn't understand. Whereas you as a human can understand what is going on in the market. Maybe we don't, but at least you know what something is happening in the market, and the black box doesn't understand what is happening. So a sudden struggle to adapt to sudden changes in market. If everybody is buying the same black box, then it's just uh, everybody is executing that trade. So there is a systemic risk, widespread use of similar algorithms. So your loophole get closed if that blocks is so efficient and everybody is trading it. So that's the limitations of black box. Now, there's another kind of a trading strategy, which is a chart pattern. So understand the various kind of chart patterns available there and read it correctly. So chart pattern is a visual representations of historical price movement. So what has happened before and what is happening now, the print is there. So it's not like a red line or the green line today and tomorrow it's they show you the red line was below the green line. It's not getting adjusted. So visual representation of historical price movement, valuable insights into potential future price trends. So you are master of understanding what is happening through chart pattern. So you are discovering the entry and you are discovering the exit points, whether it's a price target for profit or the stop loss. So the common chart pattern, there are many hundreds of chart patterns. You can spend your life just understanding the chart patterns. So head and shoulder chart pattern, double top, triple top, multiple top. Traders try to come up with their strategy on double top, triple top, multiple top, double bottom, triple bottom, multiple bottom, ascending and descending triangle, cup and handle, the neckline, the wedges, the flags, and all that. There are so many. So you can spend your life understanding all these chart patterns. So I have spent a lot of time on this. So application of chart patterns. So through chart patterns, if you can identify, you can detect the change in trends coming up. The detecting the change in trend is this detect the change in trend is so important. Understanding where the market is setting, you're reading it correctly that the change in trend is about to happen. So what it will do is, if you're in the trade, you close your trade if you're in the trade, because you're detecting the change in trend. You are early in identifying the trend, so you know that this trend is changing. Now you are stalking that trade, so you put that trade on a stalking mode, so you trigger a stalking process for that, and then you are applying some kind of a signal to give you a further second evidence. So you're gathering the second evidence, second confirmation, confirmed trend signal strength, and then some kind of a criteria which tells you that this trend, whatever signal you have, it has a strength, whether to the upside or downside, whether you are applying a momentum or volume or whatever combination of signals you're putting on that trend. So confirming the signal. And also, while you're doing it, you are also understanding where is your entry point and where will be your profit targets. So is there a risk to reward? Where would be your target? If the target is close by, then doesn't matter how good that trend is and how strong the strength is. If the target is close by, then there is a slippage. That trade is not good for you. There's a slippage there and you may miss the exit, and then not worth taking. So a lot of trades don't have any target, although they are giving you some strength. So they are the resistance is above. Let's say if you're going long, the resistance is right there, very close, so you don't want to take that trade, and that resistance is so strong that the chances of breaking the resistance. So why take the risk? So if you're evaluating a trade on a scale of 1 to 10, then you say to yourself, why should I take this trade even though it's looking so good, where the target is very close, and the target you are understanding based on some, let's say, the resistance level. And also you have to determine the precise stop loss price. So stop loss should be somewhere technically you can determine. So through the chart pattern, you are understanding where the stop loss is. If you cannot understand where the stop is, then that trade is not a valid trade. So limitation and risks of chart pattern. So this trade signal is as good as your skills. So because this is a big topic, chart pattern, big topic. So the signals, trading signals, are as good as your skills. So one trader we'll say is setting up long, one trader is setting up short, or one trader is saying that there is no signal. So it depends on your skill, what you've learned. Trapping in false signals. So a lot of time we get trapped in the false signals. So chart pattern analysis is highly subjective. So highly subjective. So beauty lies in the eyes of beholder. And there's a lot of market noise. So at any given time, Roku is going up or Roku is going down, or Shag is about to turn around. So I send a put trade, and then one trader sent me a message. Okay, you short in the Shag, and it has done a lot of time. It has given a false signal, so stay hedge. So that was his comment. Stay hedge in Shag. So I said, I don't know what kind of hedge I should take. Whereas I see Shag going down and I'm buying puts. So what do I? Why do I put an hedge in Shag? What's the point? I lose money on hedging. So hedging is hedging you can do over on the overall portfolio, but for that particular trade, if I'm making $200 per contract, I put on a hedge, um, and I lose $75. I give back $75 on hedge. So I only make 125. So I rather make 200 because I am the beauty lies in the eyes of beholder. If I'm believing that the check is going down, it's going down. If I'm putting a short trade and then simultaneously I'm putting a hedge, then in my word we call damadol. Damadol meaning dwindling. So I'm showing my I'm dwindling. I don't know. I'm not that kind of trader where I buy puts and then I say, oh, I don't know what it will do. Let's put on some hedge, and then I buy some calls against it, and then I don't know which one I close first. Call I close first, or put I close first. And if it goes a little bit, I close the calls. Little bit, 10 cents I made, and then or I lost, and then it tanked, and then or I close the puts, and then I hold on the calls, and then it reverses, and then I'm losing on calls also. So not that kind of a trading. So simple. If I believe that the stock is going down, it's supposed to be only put. And I can manage the put. I can buy more puts. I can add more, or I scale in, scale out, but only in one direction. There's another trading strategy which is called band trading strategy. So it based on the volatility. So the volatility indicators, you create volatility indicators such as Bollinger Band. You identify the price ranges, and the stock is trading in a range. So upper range and a lower range. So it's a band. You go long when the price touches the lower price level of the band, and you close your trade when the price reaches the upper band price level or the middle price level, or you go short when the stock reaches the top price level, and you cover when the price comes down. So a lot of traders, they do the band trading. I don't. So it's not my cup of tea. So I don't do Bollinger Band trading or any kind of band trading. So identify price ranges, uh, band lower. If you're looking for long and the market is bullish, the price is falling to the lower level, and you have some kind of a further confirmation, and then you go long on it. And when the price reaches the middle range, you close it or take half of the profit. And then when the price reaches the upper range, you close completely. So all that, you exploit the market fluctuation and capitalize on short-term price movement. So this is one strategy you can do. So you can set the band, such as Bollinger Band. So there is a middle band. Yes, all the recordings are posted on a YouTube channel called The Real Trade Genie. So if you go to The Real Trade Genie on YouTube, you will see previous recording, and this will be uploaded tomorrow. So in riding the bands of opportunity, so you can set the middle band based on some, let's say, 20-day moving average, or 20-day simple moving average, 21-day exponential moving average, whatever it's your criteria, you can set it up. And then based on some standard deviation, 2 standard or 3 standard deviation, or 1.5 or 1.8, whatever suits you, you determine that standard deviation, and then you create a upper band and the lower band, and then you execute your buy and sell orders at the band price levels. So I will be creating more detailed uh, strategies in a email, a document, and I will send you one by one. So I'm in the process of. So these are just bullet points, and I will explain to you in like a chapter or something like that. And then you can learn on your own, or you can contact me for further coaching. So executing buy and sell order at the band price levels. So you select your moving average, you select the standard deviation, and then you set the upper price level and a lower price, upper band and a lower band, and then you trade and combine it with some other indicators if you have, or the volume, etc. So types of band trading strategies, there are many. The most famous is the Bollinger Bands. Based on the standard deviation, there's a Dunchin Channels, identify highest high and lowest low. There's a Keltner Channels, setting average true range. So based on true range. So they have different kinds of a band trading strategy. So if you like, you can study and see if you can make some progress. So step by step, little by little every day, but do something every day. So that's all I do. I have been doing it for 12 years full time. So application in volatile market, identify the overbought and oversold condition. So oversold condition when the price goes to the lower level, overbought when the price goes to the upper level. So bands act as dynamic support and resistance level, which is very important, understanding the support and resistance level. So sometimes you may see the band doesn't act as a support. Who's saying that when the price reach the lower price band, it should stop going down and it should act as a support level? Because I say that when the market reaches the lower price level of the band, it's supposed to stop. And because I'm saying it, and because I have identified this moving average, 20-day simple moving average, because I know they use 2 standard deviation. I'm using 1.8 standard deviation, and this is my secret. So I define all that, and then I say, okay, here it is. It's reached the lower price level of the band. Now it's about to move up, and I'm going to buy some calls. And I go and buy some calls, and next day the band, the market drops below the band, and then the band expands. It expands, and then it creates another line on top. And then you say, when you say what the, then something is wrong in your trading when when you speak what the, and start throwing mouse and breaking monitors. So band acts as dynamic support and resistance level. So as a general, the band is supposed to act as a support and resistance level, the upper and lower. So capture the breakouts, price movement beyond the band. Sometimes the stock, when it goes above the band, so let's say it goes above the price upper level, then the breakout is coming. So it's going into a new territory. So the band will expand. So there's another techniques. And setting the stop levels, bands are used as reference points. So if you're going long and you identify correctly that it's holding the lower level of the band and it's moving up, then the lower price level act as your stop level. Or there is something else below the lower price level of the band which you have identified, something else which is telling you that this is the support. So there is a support below the support. So it's always good to have a support below the support. It's like basement level 1, basement level 1, and basement level 2. If you fall from the first floor, you end up in basement 1, but then you say, okay, worst come worst, I know where I'm going. I'm going to basement level 2. So that's my end. So limitations and risk management. So false breakouts, sometimes false breakouts, whipsaw, market can move up and down. So frequent trade signals. So these are the limitations. So whenever we are learning something, we need to understand the limitations and what risk we are taking, and adapting to market condition, adjust band parameters to suit changing market conditions. So adjust band parameters. So traders adjust the band parameters. So I've done it instead of 20-day moving average. Okay, let's do 21 day exponential moving average instead of 2 standard deviation. Let me see if I can do 1.8. I don't know where 1.8. You might as well do 1.75 or 2.1. How about 2.1 standard deviation? Why not? Why are you going for 1.8? Why not 2.1? So think about all that. If something you have discovered working fine, then you have edge over other traders. Now there is another trading strategy called trend trading strategy. So this is important. This is what I also trade. So I use chart pattern and then the trend. So trend is important. So riding the market momentum. So sustained price movements. So direction of prevailing trend. So once you identify what is the trend of that stock, then your objective is to go with the trend. It's just you're looking for the entry. So the entry, where is the entry? That's your job. So entry is not, it could be a breakout. Let's say the stock is exploding to the upside and then there is a breakout. So you say, okay, I'm going with the flow of the trend, or you're looking for some meaningful pullback. So that meaningful pullback price level, how do you define that pullback level? So that is very important. What you think is a pullback level, buying the dip, that may not be, uh, that's you telling yourself that this is the dip I'm going to buy, you creating it. But does the market also agree with you? If the market doesn't agree with you and you're the one who's telling that I'm going to buy the dip right here, you may be wrong. So it's better that the market agree with you. So in other words, the price level you are identifying for the dip, or we call it support, has to be accurate. So when the market is trending to the upside and then it pulls back to some meaningful level, that meaningful level is the accurate support and resistance. So I'll talk to you more about the support and resistance, importance of support and resistance, and the market participants. So it's a big topic. I'll explain a little bit more. So you go with the trend. Once you identify your entry, and then your exit could be the previous high or below the previous high or some profit at the previous high, and then the more above that high or some level. So you can adopt some technical indicators. You're studying the trend and then you're combining with the technical indicators and staying in the trend. The very important is detecting the change in the trend early on. So once we detect the change in the trend with the help of, let's say, some candles, so detecting the change in the trend which is coming, which is there, and it's uh, the detecting is one thing, but in executing or following up is another, at the right time. So detecting is one. Detecting doesn't mean that, okay, detected, now I go in. No, detecting means simply that you are on a high alert, that this is you expected. This is you expect. So that's what I did this weekend. I prepared my list of the shorts, and the longs are very few, shorts are more. So I put it on the list. So now tomorrow when the market opens, out of that list, I already know that this is my list of all the shorts or all the longs. So when the things start to happen in front of me, I need to visually see it. That's where we need to execute. You can take a flyer for detecting the change in the trend. And I tell you, I made a mistake. So last time I told you about two mistakes I made when I was talking about the VLO short and the FSLR short. So um, what happened is this: when it's very hard to put on the trade when you're detecting the change in the trend, especially when you have already closed on the other side. So last time I gave you example of VLO and FSLR. We were long in a VLO and FSLR closed with profit, then it showed a sign of reversal, but because we just closed the long side, so it's psychologically it stops us from taking the opposite side. Same thing happened last week. I spotted DE short, and I just did not take the trade because it was like a strong uptrend. But I was detecting the change in the DE is coming, but somehow I missed it. So this was one trade I missed. So it's detecting the change in the trend is one, and then waiting for that to happen. So you need to have a proper stocking process, because when the bullets, this is when one another one of the teacher. So he said, I forgot his name. If I plug in that CD, I will know. So when the bullets are flying, the things are looking hazy. So during the market hour, a lot of bullets are flying, and then the things are, you don't know what is happening. So, but if you are laser focused, that I have detected the change in the trend, and I expect this stock to do this, either it falls or it's going to rise, whatever it is you're following. So that symbol needs to go in a spatial list of a stocking process. So this is very important, and then you capitalize on it. So type of trading is trend trading strategies are moving averages, identify the trend, potential entry and exit. So moving averages like 20-day moving average, 50-day moving average, 100-day moving, 200-day, whatever it is, you you have a system, maybe a crossover or whatever. Trend line, so you draw the trend lines to visualize the direction of price movement. So trend lines you identify when you spot three price points. So those 3 price points you are identifying to draw the trend line, whether to the upside or downside. If I'm drawing the trend line, I'm drawing this way, and you're drawing the trend line, you're drawing this way. So this is also very subjective. So trend lines are very subjective. So not only we draw the trend lines, we take help from other indicators or some analysis of the volume. So what we expect at the trend line. So trend lines are there till it's not there. And the trend line I'm drawing, you may be drawing it differently. You may be taking some other lows, and I'm taking some other lows. You may be taking some different time frame, and I'm taking a different time frame. So different traders drawing a different trend lines, but it helps to visualize the direction of the price. And then on top of trend lines, you put some other indicators. There are other techniques to drawing the trend line, which is called Fibonacci fan line. So you can use Fibonacci fan line based on the Fibonacci ratios. So you need to understand what are the Fibonacci ratios and how the Fibonacci fan lines are drawn. So draw the, if you see the usefulness of Fibonacci fan line, then draw the Fibonacci fan lines. There are steps to doing it. There's another technique called parabolic SAR, so trailing stop and reverse indicator. So if you want to use parabolic SAR to capture the explosive move, maybe you master parabolic SAR. So what is the application of trend? Identify uptrend and downtrend. So that's what you're doing. Entries and exits, trend line breach. So if you identify a long-term trend line and it's breaking, so it's breaking, it broke the trend line. So now you say, okay, I was watching this trend line and it broke. So if it broke, then what is your criteria? Do you go short immediately? Or do you have some kind of criteria like distance from the trend line or number of days it is stayed within the trend, below the trend line, or a dollar percentage, or whatever it is your criteria? Or if it breaks the trend line and it goes bounce above the trend line, then you go long. So all these kind of techniques, maybe trend line, not only the trend line, but moving average crossover. So 20-day crossing over 21-day, or 8-day crossing over 15-day, whatever it is. So trend line technique. But there are limitations. So false signals, sideways or choppy. When the market is choppy, then the trend is not working. Whipsaw, sudden market reversal. You draw the trend line, the market goes above and then it reverses because the market itself is choppy. So frequent trade exit. Uh, so understand what kind of market it is and what you're trying to do. Maybe you take help with the chart pattern, not only the trend line, but take some help from the candlesticks or whatever other techniques you have. So combination of different techniques, not only just trend line. Now, another technique which is very important, and I use it, is the support and resistance. So the combination of different things. So chart pattern, trend analysis, support and resistance, volume analysis, relative volume analysis, opening range breakouts, all this combination, the gap. So if I will explain to you a little bit about the gap. Maybe there is a gap happening and it's happening above the trend line and there is a support below and the volume is huge and there is a news. So all that makes up one trade. So support and resistance is identifying the key price level. So this is very important, identifying key price level. So key price levels are those price levels where the market either reverse or stall or break it. So something at that price level. So it's not just one price point, it's a range. So there's a like a channel, little channel. The so it depends. How wide is the channel, or how narrow is that channel for the resistance level? So just imagine drawing a rectangle line like a river. So the river is wide or river is narrow. So that price level. So when the market is trading in that price level, in that river, and there's something going on, the psychological barriers. So support and resistance are created because of psychological barriers. And if you visualize, if you visualize right now and say, okay, psychological barrier, what is he talking about? And then he's saying three market participants. So think about the three market participants. They're creating some kind of a barrier. That's where the sort of resistance and supports are created. So who are those three market participants? There's a market participant who is long, there's a market participant who is short in that market, and then there is a market participant who is sitting on the sideline. So the guy who is sitting on the sideline, he's watching this stock moving up and down. So what is happening? One is long and one is short. So somebody is going to win. When that somebody is winning, that's where the other part, the third participant, he joins that side. So and not only that, if there was a guy who was long, and the guy who was short, he wins. So the smart guy who was long, not only he will close his long position, but he will join the short side. So once he joined the short side, now there are two. So one guy who was already short, and now there is another guy who is shorting. So there are two guys. And then there is a third guy who is standing on the sideline, and he's saying, okay, let me see who wins. So he sees that the market is winning on the short side. So he joins. So now there are three participants. So they create the market. And now there is a big barrier, that psychological barrier. So the market every day on an intraday level or on a weekly chart, monthly chart, daily chart, they are creating these price points. So these price points are support and resistance. So this is a very, very, very important to understand where are these barriers where I can take advantage. So if we identify these barriers, support and resistance level, where the market has fought, the previous battle. So combining it with the trend, or combining it with the chart patterns, and combining it with the volume. So chart pattern, trend lines, volume, support and resistance, combine all that, creates a proper entry and exit. So that's what it is. So understand the psychology of these participants. So understand the psychology of these participants, and you have an edge over other traders who don't understand the support and resistance levels. So mastering the support and resistance is your key to trading success. So that's what I believe. Support level is where buying interest is strong enough to prevent the further price decline. So you're betting that this support level is so strong that it will prevent, and this is the right time to enter, or if you're already in the trade, to add more to the position. So this is where you receive my trade alert saying buying more, because I'm doing this. I'm identifying the support level and believing in it, and then sending you the alert to buy more or add more, even to the upside. So when I'm sending alert to buy more when the market is already in profit, something has happened, and that something is there's a test of like Datadog is doing right now. So Datadog, even if the market is red, the Datadog doesn't want to go down. So Datadog is the one where the declines are being supported at 90 level. So it's a very strong support at 80, 88, 90 level Datadog. So whenever the market moves down and then moves up and then pulls back, so that is the resistance level. And then 90 level, let's say 90 level, and then it pulls down and then moves up, then there's another creates a resistance level, again tested, then another tested, but finally it breaks through. So when it breaks through, like Apple was doing at 193 and 194 level. It was testing, it was going from below to the above, 193, 94, and this is where the fake break occurs. So Apple was doing it. I went long at this one point. I went long on Apple because my target was 198 and 200. So when it broke 194, I went long, but I knew I have to be very quick in taking profit on the long side. And then finally, it just there was a sell program which triggered on July 19, and somebody big boy, whoever he or they were, they sold Apple at 198, and then it broke 193, 194, and then all the way down now to 173. So collective actions of market participants took place in Apple, and you will know later who sold Apples. So identifying support and resistance. So swing highs and lows. So this is another clue, another technique. You need to understand the swing highs and swing lows. So swing highs is creating the resistance and swing lows are creating the support level. There are another technique which you can use, the psychological level numbers, 100, 200, 500, 1000, 2500. So 200 doesn't mean just 200 round number. No, it could be 198. So 100, 200, 500,000, these are psychological levels. The market act as a, depending on the direction, the market act as a resistance level or act as a support. So keep these numbers in front of you all the time. Keep moving averages in front of you, like 20-day, 50-day, 200-day moving average, because the big boys are on, if you go on CNBC or Fox, they're talking about 20-day, 50-day, 200, and then they don't, so they come and they say, okay, I'm buying it because it's holding 200-day moving average right here. I added more to my position. Or they say like this, it's time to take some profit off the table. They're always talking about it's time to take some profit off the table. So where was your entry? Can you tell me where was your entry? So I can take some profit off the table. So I ask them. And so, or the stock is bouncing from this 50-day moving average. So I'm going long. So you don't believe these are just numbers. I mean, 20-day, 50-day, 200. They act as this self-prophecy. So they act as a self-prophecy. So you're just aware of these averages, and then you're doing it something. So you're aware of these averages, and you are looking for other clues for confirmation. Okay. Um, so what time period do you use to identify the trend? So everything for me is, it starts with the day chart. So everything for me is a day chart. So think about it, when the market open, so market doesn't open on a 5-minute chart, or market doesn't open at a 15-minute chart. If I'm quick, I can take overall the market is tanking, but then it's reversing on a, let's say, 5-minute chart, and I can see it's reversing. And then I say, okay, how about if I capitalize on this quick, it's establishing a short-term move on a 5-minute chart, and how about I take a weekly option? So, but I know that I'm taking a 5-minute chart. I'm going counter trend because overall the market is down, like Nvidia was doing it last week. There was no time for me to send. So Nvidia was going down, but on a 5-minute chart, it started to move up. So I went and bought a short-term call, and immediately later in 15-20 minutes I closed it, locked my gain. It was a very quick and a counter trend. But for me, everything starts on a day chart. So when the market open, the bar is printed on a daily chart, right? So the bar is printed. It doesn't print on a weekly chart. Weekly chart is made up of a 5 trading days. So it will print a little bit. So you can see the weekly chart. You can lean against the weekly chart as a, you say, okay, the weekly chart is also showing me the downtrend, and daily chart is also going down. So the trend is my friend. So everything begins on a daily chart. But then once you see where in the landscape of daily chart, the bar is there, whether it's a candlestick or a bar or a price chart or whatever it is, then you need to flip your that symbol into intraday charts. So you need to have a workspace for intraday levels. So what are the time frame for intraday levels? So that's where you see. So for me, I have 2 sets of intraday, very small time frame, like 3 minute or 5 minute, and then 30, etc., all the way to hourly chart. And then I migrate from hourly to 2 hour and 4 hour. And then there's 4 hour and a day chart and a weekly chart. So you need to flip and see. So, but everything starts with the day chart. So, and then you're seeing it, what's happening. So day chart can show you that the stock is moving down. But if you forget to see the shorter term chart, like 5-minute chart, the stock has already bottomed or it is in the process of reversing. So now you say, okay, day chart is looking good, but on a 5-minute chart is reversing to the upside. So I need to be patient. So I remind myself, if Bruce Lee was here and he's watching me, he would say, okay, Noshi, you need to be calm. So that's where the 5-minute chart. So when the 5-minute chart is retracing to the upside, then I start figuring it out the resistance level on a 5-minute chart. And on so one this thing is going on, and on the other hand, I'm looking at the options. So for options, there's another window. So I'm looking at the options, and I'm seeing the activity on the options. So which options chain is blinking fast? So which strike, and where is the volume? So if I'm looking at it, I'm not the only one smart um, guy sitting in San Diego. I'm not the only one. So there are other guys. I need to know what the other guys are also doing. I better follow the crowd and not blindly follow the crowd, but at least somebody is there. I'm not alone. So you can see it, which strike. And then when you're watching it laser focus, like on your cell phone, just everything is on a big monitor, 27-inch screen, but that little option chain, you laser focus on your, let's say, on your cell phone. So cell phone is a little screen. You just open that option chain and you can see the strike. You laser focus on that month, and then you can see, okay, strike is 20 or 25 or 22.5. Which one? Where's the volume? Where's the ask? Where's the bid? Just laser focus. Then you know exactly where the action is. And the action in the strike also tells you the target. If a lot of action is happening somewhere out of the money strike, that's where and if it matches your analysis, then you know that the smart boys, they're buying out of the money puts, let's say, and they're buying out of the money puts, and the strike is such that that is your target also. So when that stock hits the target, that option will be at the money, where that's where the premium will be the most. That's where you will exit. So you're buying out of the money puts, let's say, and the momentum is there, everything is lined up, and you're buying out of the money puts, and you're basing it based on the either when the target hit, that option is at the money or in the money, and that's where you will lock your gains. So for out of the money puts, you need to be right and right fast. Or you're just taking a flyer, you're saying, okay, I expect this to drop. I detected the change and I'm waiting for that to happen. So, so to answer your question, everything starts on a day chart and it goes all the way to 3-minute, 5-minute chart. So it goes like that. So application of support and resistance trading. So identify entry and exit points. So support and resistance, because that's where the battle is fought. So it's very important that you know where the battle is fought. So you either avoid the trap. So if you understand where the battle is fought, you will avoid the trap, or you are waiting for the stock to come very close to that level where you have identified, so you can take proper action, whether it's your exit or entry or what, or adding to the position and setting the stop levels. At that support and resistance, if you identify correctly, you will see the market sentiment is automatically the things start to move at that price level. However, so there is always a if and but. So these are one if and but. If you read somebody's commentary on the stock, they will write in such a way that they will be right all the time. If this happened, then this. If this isn't it, otherwise I will do this. I will take profit here. Blah blah blah. All that they will make you convince. It doesn't matter what. So I'm just saying. So gauge market sentiment. So at that price, wherever you are identifying support and resistance level, so you need to now go deep at that level at a 5-minute chart and confirm with other evidence. You need some other evidence, because the way you are thinking that this is a support, so always be paranoid, always be suspicious what the other guy is doing. So always be suspicious what the other guy is thinking. The guy who's sitting in Fiji Island in his pajamas, the guy who you see sitting on a with a laptop on the beach, one girl on the right hand and another girl on the left hand, that guy. So that guy, what he is thinking. So I better be just understand that I'm not the one sitting in my pajamas in my home in San Diego, and the guy who's sitting in shorts in the Fiji Island, he's thinking something else. So just be careful. Put some other evidence, and then if you are right, you will see, you will get the good feeling. So pay attention to your internal signal. So the price level which you're seeing is the external. So, external, you're seeing it on the chart, but something should happen to your body. I'm not making it up. Something needs to happen that you feel good, like you driving by and you see a house for sale, like you say, oh, for sale, fine. And then suddenly you say, yeah, this is out of 50 house, I bet this is the one where the buyers are. And open house sign says open house tomorrow. And you go there, let's say Saturday, Sunday, open house, and then Monday goes by and you are just thinking, and then on Tuesday you call the agent and you say, okay, what's up? And then he say, well, no, that house is gone. So that's the kind, that house is gone. And whereas the other houses, they are just sitting there for sale sign. There's nothing unique about the other home. There was a uniqueness in that home and it got sold. Somebody saw that also. So same way, there's something unique going on and you can spot it on a 5-minute chart or something, which tells you that this support and resistance is a valid support resistance. So there's a false breakout can occur. There's a choppiness, frequent breaches of up and down support and resistance. They can break up and down and all that. So when the support is breaking to the downside and then the stock is going up, then it's breaking to the downside and then it's going up. So be very patient, because a market is undecided. So one way or the other, the market will decide. So let the market decide, and then you join as a third guy or Or if you are already in the trade, that's it. You just wait for it and become a third guy. So multiple time frame analysis is very important. Evaluate support and resistance at several time frames. So limitation and risk management. So now there's another trading strategy which you can adopt, and I use it. So I'm telling you multiple combinations. So breakout trading strategy. So breakout trading strategy is capitalization on trend reversals. So breakout, whether it's a 52-day moving average, 52-day moving average, or something like you say, okay, I only trade a 30-day breakout. I only trade 21-day breakout. I only trade the breakout from the resistance level, or I trade the break of the support level. So whatever is your strategy for breakout. So price breach key support level, so you go short. So this key support level you have identified before. Price breach key resistance level you have identified before, and it goes above the resistance level, you go long. I rather prefer, so my strategy, I rather prefer that the stock bounce to the support level from top, goes to the support level, and then it bouncing to the upsides. When it bouncing to the upside, I prefer uh, to go long, because then I know that that's my exit for a stock. When the stock goes break the resistance level, then I'm on the lookout. If I'm already in the trade and the price is breaking the resistance level, then I am on the lookout that this break of the resistance, is it a valid resistance, or I'm getting trapped. So I'm looking for the clue. So the clue comes, maybe some indicators, maybe some candle chart, something is there which is telling you that even though the resistance is broken, but this resistance broken is not strong enough. Or if it's strong enough and I'm already in the trade, I can add more to my position, even though I'm adding at a higher price because I'm scaling in. So if I'm already in, let's say 100 shares, I can enter in at, if the price breaks the resistance, I can enter another 50 shares. And then I have 150 shares, 100 at lower price, 50 at a higher price. So I have some kind of a moving average. It went up, but not that up, because the lower price is 100 shares more. And then at the higher price, I bought less. And if as another resistance level, then I will add another unit. maybe this time 25 shares. So I'm moving, capitalizing on it, on the stock which is going in my favor. So I'm riding the trend, or I'm just initiating a trade. There was a big resistance level and it broke and I enter long. And I can also do the trend reversals by identifying the break. So sometimes if you read the resistance level correctly, and there's a resistance, so resistance level reading correctly doesn't mean that that the stock will fall. But if it's hitting the resistance, and you know this is the resistance level, if it's hitting the resistance and it's falling sharply, uh, like I think X is setting up like that. So we were long in X, and I will show you the chart, and it gapped up. We closed it to 30.31. Now X is setting up for short. J&J is setting up for short. And there's another one, Amazon, etc. So there are a few stocks which are on a watch list. So X is one of them. J&J is another one, and Amazon. So potential trend reversal is coming. So I already identified this, and I will be watching it. Potential continuation of trend also. So potential continuation of trend if the resistance is broken or support bounce. So some kind of a breakout. And the breakout when the sharp reversal is happening. So when the stock hits some resistance and the sharp decline is happening, that's the that's a more profitable trade than on the downside. And if the sharp reversal is happening from the support level, then that's another profitable level, profit trade. Just this is breakout trading strategy. Now another one is so breakout above resistance, breakout below support, and breakout retest. So these are the different strategies you can adopt, whatever is happening at that time. Now the trend reversals, so capture trend reversals, confirm breakouts. So when you're confirming the breakouts, use volume and other indicators. So you do use some volume and other indicators to test the strength. Set price targets. So when the breakout is happening, people don't understand. If the breakout is happening at an uncharted territory, then the people don't understand where to set the target. So setting the target is based on some where the bounce has occurred and the previous high. So measure that distance from the bounce which has occurred from the swing low to the previous high, and then add that distance to the breakout level. So there's a limitation. There's always a limitation. So false breakout, false signals, whipsaw can occur. You think it's a breakout is happening. Mostly the breakout occurs, and then the traders they get trapped, especially on a 52-week or some kind of a breakout, 52 weeks or a new high or something like that, and then the traders get trapped. So be careful about that. Whipsawing, sudden reversal after breakout, frequent exit, volatility management. Consider volatility of the underlying. So it's when you are trading the breakout, consider the volatility of the underlying, such as Tesla. So if you're trading Tesla, then if, you can make a lot of money on trading Tesla, either on the calls or on the puts. But remember that Tesla is a highly volatile stock. So adjust your position size accordingly. So the trading strategy is the price break key support levels or price breaks the resistance level. So another one, types of breakdown strategies. The breakdown below support, so expect the bearish continuation. Breakdown retest, wait for a retest, then enter short. Or breakdown momentum, use some momentum indicators. In other words, when you are spotting the breakout, use some kind of a momentum indicator, use some volume validation. So use some volume validation. Now the trend reversals, I think I talked to you about that. Yeah. Okay, now the another strategy which I use often is the gap trading. So gap is the difference between the close price yesterday and the open today. Yeah, I'm not muted. So gap trading is exploiting price gap. So the gap occurs when the difference in the price is between the close and open is different, whether to the downside and to the upside. So if there are 9,000 stocks, all of them are gapping. So set some criteria, such as a percentage or a dollar amount. So I set a percentage in my system. I've set up a percentage that if a stock gaps down or gaps up a certain percentage, these are the stocks which I will look further. So the gap is, when the gap is occurring, it's occurring on a day chart. And if your system is set for a certain percentage, you will see those gaps on your day chart. So these are unique trading opportunities. Gaps are uh, can be complex. So so when the gap is occurring, let's say the stock gap up, it needs to. So what kind of a gap it is? Is it at the beginning of a stage, or at the middle of the trend, or is the exhaustion gap? So if when the gap is occurring, I I need to look at whether the gap occurred above the resistance level, or it has occurred in the resistance range. If it has occurred in the resistance range, then that gap, I don't expect the gap to continue. So it's like this. Let's say I give you the example of a river. Let's say a dog is chasing you, and you are approaching a river, and the bad guys are coming, and then the dog is chasing, and then you have no choice. You just dive in the river. You dive, and then let's hope the dog doesn't chase you. So if the gap is not, and there's another scenario. You reach the river, you magically found a rug, and you took a ride, and the rug or that carpet takes you on the other side of the river. So now the dog is on this side, all the bad guys on this side, and you are on this side. So that is the concept of gap. So when the gap occurs, you are on the other side. So you know that you are on the other side, and you better not come back in the river. So that kind of a gap continues. So how do we know that this? So that's where it is. Where the price closed yesterday, where the price opened today, how far is the gap? Is that a big gap? If it's a big gap, then all the move has already done. So it's no use to chase that gap. If the gap happened and it is still okay, but you know that there was a river, there was a resistance, and all that resistance is conquered just like that. And the market opened on some catalyst, and the market is on the other side. Now uh, so you have identified that this is the gap I will take. So now you're waiting for the move to the pullback, some kind of a pullback on an intraday level. So if you flip your chart on some intraday level, like 15-minute or 5-minute, and look for the retracement at the proper level, and then you time your entry. So it's little complex to trade the gap, but I do that over the time period. I've learned how to identify the profitable gaps, whether it's to the downside or to the upside. Mostly the gap I trade is to the upside. So gap up trading and a gap down trading. And then there is a gap reversal trading. So gap up, gap down, and then gap reversal. So gap reversal is, there are two kinds: gap up reversal and gap down reversal. So at, at what is happening is, you know what is happening, and then you're employing your strategy. You can, I when I'm trading gap, I combine it with the opening range breakout, and I evaluate the support and the resistance level, whether it's on a day chart or an intraday level. So all that support and resistance levels, the opening range breakout strategy, and all that combined, and the volume analysis, not only the volume but the relative volume. So relative volume, the support and resistance. What else? The opening range breakout, all that combined creates a profitable entry for the gap. So so the gap is occurring when something new has occurred, something new, brand new, a catalyst, whether the CEO who pinched a girl or secretary in his office and he got fired, and the market likes it and the market is moving up, or they close some department somewhere in Timbuktu, so the market liking it and the stock is going up, or there was a food poison in Chipotle and they said, okay, we figured it out. What about the reason for that poison? And we are all good. So now you can come and buy our burrito. So the Chipotle gapped up. It likes it, and then it gaps up from 225 level to 250, and that's the beginning of a new level. So that kind of a gap. So that's what you're looking at. Whereas the other kind of a gap is just market maker, just somebody buy 100 shares and it gaps up, and then a twinkle twinkle little star gets created on a day chart, and that's it. Nothing happens. So in gap trading, you can capture the quick profits. So I don't trade gaps just for the quick profits. Analyze it completely, and then I'm in it for few days. So I don't just go for quick profit. Identify market sentiment, potential trend change. So when you're analyzing the gap, you ask yourself, is there a trend change occurring, or is it at the last phase of the trend, the exhaustion gap? So how far this market has already moved and the gap is occurring. So if the market has already moved and then there is another gap, that may be the exhaustion gap. So you don't want to trade that kind of gap. The party is already over. Or maybe it's in the middle of a trend. So the market has gapped up already or moved up, and it's took a breather, and now it's a new gap. So a second gap. And after the third gap is too much. So set a stop level beyond gap to manage risk. So what the traders do when they're trading the gap. So when we are trading, we need to know how big. If we are trading gap, if there is a big gap, where are you going to put the stop? Are you going to put the stop based on your preference of a dollar? Because technically that's not your stop, because the market can move down, pull back, and if you set the stop willy-nilly, then you are out. So if the gap is big, I'll buy, and I'm still going long, I will buy less shares. If the gap is tight and I know where the stop is, which should be below the gap level, where the gap occurred, even below that, because if I'm setting the stop based on the yesterday close price, everybody knows that that is a strong support. So yesterday close price is a strong support, and if I put the stop right there, I'll be taken out, and then the market moves up. And why the strong support? Yesterday's close is a strong support because those who are not in the trade, they are regretting and they have a remorse. They're saying, oh my god, yesterday close was 100, today it gapped up to 104 and it's moving up. Man, I'm not buying it at 104, but I will buy it 100. So they have a remorse. So they are waiting for the stock to pull back to 100 or 99 or 100. And if that's where I put the stop, the stock will pull back, take out, take my stop, and then move back up. So I need to put my stop away from somewhere away from that. If that stock hits that price, I'm really wrong in it. So properly define your stop. If the stop is wide, you need to buy less shares. If the stop is if the gap is tight, you can buy more shares, or you initiate a position. Sometimes what happens when the stock gaps up and you think you cannot decide. Let's say you cannot decide. Oh, I don't know where's the entry. Do something like buy like one share or maybe 5 shares or 10 shares or 50 shares, whatever it is, or one contract, two contract. Initiate your position, and if it goes up, okay, fine. If it pulls back, then you know that you have some dollars left from the trade, which you allocated. You can allocate and average down. So if the breakout or the gap occurring and you cannot decide, then initiate with a little position. When you are in the position, then you have a skin in the game. So if that is your thing, you're happening to you, you're missing out, initiate a little bit. Gap fills, not all gaps continue. So there's a gap fill. So the gap fill means the window open, window close. So window open, window close. So when the window close, so gap fill, that's the support level. So you identify that, okay, is this is the support, and is it holding, or the window even close and the market is going down on a gap up case. So when the stock gaps up and next day if it gaps down, on some overnight risk something happen, then gap is a bad trade. Because if the window opened and then the window got closed and the window not only closed, it just keeps going down, then that is a bad trade. So you have to exit. Or if the stock gapped up, let's say on Monday, um, and it gaps down on Tuesday, that's the entry. If after watching, that should be the entry to the downside. Or if the stock gaps down on Monday and then the stock gaps up on Tuesday, there's a possible entry for long side. Now, there's another technique I deploy on a gap is the opening range breakout. So opening range breakout, there are windows set where on a time interval, uh, the stock is moving from a 15-minute window to 30-minute window. So it's making some kind of a high, some new high is made. So I note down the high made during that 15-minute window. And if if the gap is really, if there's no pullback, then that symbol should transfer from a 15-minute window and make a new high on a 30-minute window. So that windows I set and is something called opening range breakout. So this is another session, which I will teach you some other time. So gap reversal. So there's a gap up and a gap down. So, and then there is a gap reversal. So gap reversal trading strategy is profiting from the market turnaround. So specialized techniques. So gap reversal is when the twinkle twinkle little star is formed on the candle instead of a cannonball. So when the gap up occurs, the stock should stay like a cannonball, like a big white candle, and it starts, there's a momentum. So if you're analyzing the 15-minute chart, you can see there are something called white horses. So there's a one candle which is moving up, then there's another candle moving up, so you can see the move. And then if so there's a smooth ride to the upside, so that kind of a gap. But if the gap occurs and then on a 15-minute chart you see the pullback, and then you see some red chart candle, then there's some up move, and then there's some down move. So you can draw the line, you can draw the horizontal line on that 15-minute chart. The high is here and the low is here. Now the stock is just trading, and if 2 hours gone by and the stock is still trading in that range, that's not the kind of gap I'm looking for. So the gap reversal is sometimes the gap occurs. So let's say the stock gaps above the resistance level and then it pulls back below the resistance and then it continues to fall. So that is where the short can be deployed and buying the puts. So it's a reversal of the initial move. So the gap up and reverse down. The profitable gap trade is when the stock gaps down and then it reverses to the upside. So there are a lot of reasons for the stock to gap down. It could be some bad news, etc. And then the stock gaps down. But the beauty lies in the eyes of beholder. So what happened? The stock gaps down, and the big boy, somebody comes up and decide that this is the fair value of a stock and I need to unleash my buy program. And they unleash their buy program somehow, somewhere the stock gaps down to some key support level or some important moving average, such as 50-day moving average or 200-day moving average. And then you see tuck, 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 that the stock just starts to move up. So when the stock is reversing to the upside and you are very quick in whether going long or buying calls, then your job is to know where is the resistance, where the stock can um, stop. Is it before the below the yesterday's close, or is it, if it goes above the yesterday's close, then you know that not only the stock has reversed but it's going to the upside. I'll show you EXPE chart, which I traded long after the gap down. So I'll show you that chart for the gap down reversal. So types of gap reversal: a gap up reversal, selling short; gap down reversal, going long; gap fill trading. So you identify the gap is filled and that's the support level, so you go long. So a lot of gap trading. And in application in identifying trend changes, capture the trend reversal, confirm signal strength, use volume and indicators, set price targets, measure the height of the gap, where it all began. So it's important to identify where the gap has begun and where it is now and what is the distance. So all that, and where is the next resistance level or where is the next support level. So all that goes on in the gap analysis. false reversal can happen. So we think that the gap down has occurred and now the stock is moving up. So I go long, but that reversal is a quick profit taking. So it could be, remind yourself, if the gap down has occurred and a reversal is happening, is it a quick profit taking? Somebody is taking the profit and then you think the market is reversed and you go long and then it hits some resistance level like a midpoint of the gap and then it creates a new low. After 2 hours, it's making a new low and you have established a long position. So if that happens, you need to exit. Your fate has decided. Sometimes the fate is decided quickly. So it's okay. You committed yourself and your fate is decided right away in 2 hours that your gap up reversal trade is making a new low and you need to exit. All that. The last strategy I'm talking to you is the intraday reversal. So intraday reversal can happen and it's good for short-term traders, the day traders. So stock hits some kind of a support level and is bouncing up. Something happened. Maybe the market, that stock was moving very nicely to the upside, and then some news came up, FOMC news or something happened, and the overall market is pulling back. And there's nothing wrong with that stock, and it pulls back to some support, and you were watching it. So and then now it's the good news come back and then the stock is reversing. So if you can time that intraday reversal, some kind of a hammer candle or some kind of a sharp reversal, and you can spot it on your intraday chart. So that's one strategy, and you can even deploy short-term options like weekly options on that stock if you can. So it's popular among day traders. So that's intraday reversal. So key reversal, there's something called key reversal, which is making new highs or lows, but close in the opposite direction. So the stock moves up, makes a new high, and then by the time the day close, it turns negative. So that is a key reversal. So intraday reversals happen, taking help with pivot points. So if you're using pivot points, there are many methods of calculating the pivot points. So if you have calculated the pivot points and you believe in it, so it hits some kind of a pivot points and you consider that as a resistance level or as a support level, then it's like everybody is using that formula. So it's magical. So sometimes, when everybody is using it, that becomes a magical price point and you can take advantage of it. You can deploy candlestick on top of the pivot point. So not only the key reversal you're identifying the pivot point, support and resistance levels and the volume, and then some kind of a candlestick. So candlestick, whether it's a doji or engulfing and others, you're deploying all these techniques to identify that this intraday reversal is genuine and I'm going with this trade. So that is intraday. So capture the short-term profits, manage risk. For this kind of a trade where the intraday reversal you're going, you have to have a proper stop loss, because then the loss, if you're wrong, then the stop loss gets stop amount gets bigger and bigger, because your reason for that trade is no longer valid. If you thought that this was the key reversal and it's no longer a key reversal, it's going against you, then that was your reason. So you need to exit from that trade because that reason no longer holds true. The last slide on this, and then there's another one, sorry, too many strategies. So false signals can occur, market volatility, erratic price movement. So you're going up and down. Oh no, is it going up? Is it going down? So you need to be very careful in intraday reversal. So this can be a haphazard trading. So don't go, if you don't know, don't do this kind of haphazard trading where you're trying to capture the intraday reversal and you're trying to go on a weekly options, and then the sword is hanging on you and the losses are piling up and giving you stress. So don't do that. uh, it can be very hazardous to you, so don't do that. The last strategy is the moving averages breakout. So people trade moving averages breakout. They have 20-day moving average, 40-day moving average, 50-day moving average, these kind of a moving average breakout, the moving average crossover, one moving average is crossing above the moving average. So they deploy all these kinds of trading. They have a trend trading system where they identify the trend, they draw the line. Now they're looking for the entry. So they're looking for the entry So they're taking help from the moving average. So let's say 10-day exponential moving average. So they know this stock is trending to the upside. Now I'm looking for some kind of a pullback. So pullback, you say, okay, 10-day exponential moving average, and I'm using exponential moving average because it's a short-term moving average, and it adjusts quickly. So when the stock falls to 10-day exponential moving average and it holds, and it looks like it's breaking up, that's where I go long. And then if it goes below the 10-day exponential moving average, so my fate is decided. I am no longer, I should not be in that trade. So that kind of a techniques you can deploy in a moving average system. And the moving average crossover, one crossing over the other, moving average bounce, so 10-day exponential bounce acting as support or resistance, and you have already identified the trend. Moving average, there's something called moving average envelope. So you can use envelope where the two moving averages, one on the other upside, one on the downside. So you can plot the moving average envelopes. You can use adaptive moving average, a weighted moving average, exponential moving average, simple day moving average. You can draw 365 moving average. All right. So all these kinds of I already explained. So capture trend continuation, price breaks above or below moving average, trend reversal, price targets. You can set the price targets to next level, etc. So these are all the moving average trading. But there's a limitation. So the moving average is you are defining moving average. So there is just a line. It's just number of days. So if you think 10-day is valid, okay, 10-day. I say no, not 10-day. It's 8-day. So if it's an 8-day, then I'm going for 8-day. You're going for 10 days. So if you're going for 10-day, your entry may come early, or your entry may come late, whereas I'm saying 8-day moving average, and I may go long on 8 days. So who is right? I mean, we don't know. 8-day, 10-day, the market doesn't know that you are using 10-day or 8-day. So some kind of other indicators, volume, etc., you need to apply. So I'll stop here and I'll show you, just a second, I'll show you some charts. Just a second. I'm opening another presentation. So I show you just some charts quickly where I took the trade. So here is the recent example of PDD. So it's hard to describe on the chart, but I'm showing you that this is what I did. And there is a thought process going on. So what I am thinking at that time, I don't know what was happening in the market. You don't know, or maybe I don't know. If I don't create a journal, what was happening at that time when we took the PDD trade, you don't know the reason, exact reason. So what I remember when I spotted this PDD, the Chinese stock were tanking. They had gone up, and like Baidu, and they were tanking. So we went short on Baba and then also on PDD. So entry is shown on a blue line, and then the exits. So exit is, I don't know why 22% gain looks like it's less. This percentage is wrong. So the short, we went on a reversal puts, and then next day when it gapped down, we exited. Roku. So Roku was pulling up, and overall the trend right now, the trend to me for Roku is to the short side. So I entered blue line short puts here and exited when it reached the 50-day and it started to bounce, so exited with a 37% gain. Here is the shack. So the shack broke the 50-day moving average, and I mean, if this candle doesn't tell you that the shack is tanking, then I don't know what else you need to know. What you need to know here? What kind of indicator or things you need to know in order for you to establish a short position? So there was a consolidation right here, and then I'm 1 day late, or no, I went long. I went short here, where the blue line is. I'm not sure if I went short here or next day, but we exited on Shag right here, 250% gain on the puts. Yelp. So Yelp Again, Yelp, there was a lot of Chinese stocks were going down on that day. So Yelp, I entered puts here where the blue line is and exited right there, or the 3 4 days later, 35% gain. I show you KBH. So the home builders were going down. So when you're looking at the home builders, so there's some news. So KBH going down, LEN going down, or Toll Brothers going down. So Lennar going down, KBH going down, or Toll going down. Oh my God, all of them are going down. So let's choose which one. So maybe two of them. So I chose KBH. So you see there is a consolidation here, and then this break. So established the short position and then exited here. When I exited here on KBH, and the reason I exited was because of the 50-day price, $50 price. So I exited at 40, between 49 and 50, but it broke 50. So it has established a new another short on a pullback to 50, and then pull down. I will go short. But what I did, since I exited KBH, so I said, okay, I'm exiting KBH. Now I need to find another home builder. So I look at Lennar. So I said, okay, Lennar is the one I will establish a short position. So I established on Lennar. So having a list, having a ready-made list of your stocks in that industry group or in that category will help you immediately switch, because when the bullets are flying, the things are looking hazy. And then at that time, you don't ask me, don't call me, don't email me. I'm just watching this. So I focus on this. So no email, please. No phone. Phones are off, and emails are off too. I'm not watching email or phone or etc. So KBH, then now BSC puts. So you see, BSC we traded BSC calls on this, and then it start to pull back. All the bank stocks are just getting hammered. This is another sign of the big market weakness. So Bank of America. So when it gapped down, the window opened. So what are the chances of Bank of America to, when it gapped down, it starts to go up when it did not show any sign. So what are the chances? If it goes above 31, 38, or 32, yes, I'm wrong. But if it goes down, what if I'm right? So BSE, 81% gain. Riot. So when the AI stock, Riot, when all these kind of stocks are tanking, so just choose. So entered short here where the blue, and then exited here, 55% gain. Neo. So when Neo is tanking and the Tesla is tanking and RIVN is tanking and GM, so GM was tanking. I went short on GM also and Tesla. So Neo is the one right here. So gap down, and then I bought the puts, and it did nothing but crash. 80% gains. PNC, so it's a bank, again another bank. So BSE and PNC, I exited here, bought the puts here, right at the level when it started to break 50, and then next day it gapped down. I exited with put gains 37%. X 162% gain. So X took time. I went long here on X. So you will say, yeah, why you went long on 25 and then it went to 24, so 23, and then it gapped up. So X, I closed. Now X is setting up as a short. So it cannot, if you look at the day chart of X, you see it's creating a big resistance between 31 and 32. Between 31 and 32, X is creating a big resistance. And then you look on the left side. So when you look on the left side, it has created the previous resistance. So when it gapped up, so send the alert to close X, close alert, because when you look on the left side, so don't forget to look on the left side, because the left side telling you something has happened. So 30 level is a very strong resistance. And these guys, so imagine, look at this one. At 30, 31, somebody sold X. And then when it reversed to the upside and reached 30, 31, people sold all the way to 20 levels. So imagine all these holders at 30, 31, they bought and they saw losing all the way to 20 level, and then it gapped up. This is their chance to exit. So they ask question later, shoot first. So now, what are the chances of X going up or going down? You think about it, going up or going down. So chances are that it's going down. I know the volume is huge. Oh my God, look at this volume. So this volume is a climax volume. It could be a climax volume. Like nobody left. I don't know who else is left there. Mama, Papa, and everybody, the taxi driver, and everybody is in it. Look at this volume and look at this huge volume. I don't know if it's a buy volume or a sell volume, what it is, but I know that 3031 is a big resistance. So I'm watching X for the puts. VLO. So this is the trade VLO. So if you look at VLO broke this range, so I went long and then I closed at 136, 137. The very next day, I don't know why it's 18% gain. Sometimes the gain is a percentage is gain, but 18%, but the dollar amount is big, like $400 or $500 contract. So it looks like 18% gain, but when you look at the dollar, also is for $400 per contract or 500 per contract. So BLO next day gave us short signal, but I hesitated because I just entered long and I closed it. But why would I go short when I just closed long? So I did not. It's psychology, and then it reversed to the upside. Now it's downside, and then now it reversed to the upside. UPST, so upstart clobbered. I went short, and so if it gapped down and it's doing like this kind of a price action, so what are the chances that, oh no, I go short and then it will reverse on me and then I will lose? Chances are that I will make money first and then it will reverse. So chances are that it will make me money on this gap down on a volume rather than make me lose money. So lose money, yeah, if it goes above and fill the gap, I'm out. But I'm not. I made 73% gain. RIVN, so same as the NEO, same day, I think NEO, RIVN, 57% gain on this down day and then close at this. GM, so again, you see the same thesis. So all auto stock. So if GM is going down, NEO is going down, RIVN going down, Tesla is going down, oh my God, everything is going down. So in the auto sector. So that is a double, triple, quadruple confirmation for me to open a trade. So this is the trade I open on GM and boom, 44% gain. Roku. So Ride is going down and all the other stocks are related to, going down. So Roku, what are the chances when I'm entering in this put trade? Look at this. What are the chances that Roku will just go up when I'm entering the puts? What are the chances? Will it not go down first? Like let's say 2 days or 3 days, it goes down 2, 3 days. I will be, I'm entering puts on 85. I'm closing at 79. I'll make 50% gain. FSLR. This is the trade. I went, solar stocks were moving and I chose FSLR and timed it. The next day I entered, I closed because I bought a weekly, like 2 weeks. The options were very expensive and 2 weeks, expiring in 2 weeks. So the time was not on my side. So I wanted to close fast. So next day I closed it with the gain. And then it reversed. Now but I did not buy puts. So I explained to you I did not buy puts. And now it's tanking, is like going crashing down. So I missed the short side. CLF. So CLF, what are the chances of CLF breaking this 1550 support that it will go up? Not it will go down first. What are the chances? So I bought puts, went short, but made money. Chips stock going down, so AMAT. So I bought AMAT puts. What are the chances? So what are your, yeah, Run is losing money right now. So what are the chances that AMAT is will go up, then go down? And the size, so the size of the trade, I can have $1 million account and someone can have a $5,000 account. So size depends on your portfolio size and your risk. So you cannot you trading is independent. So trading is independent of what your neighbor is doing. If a neighbor can be trading with a 5,000 and you can have a $50,000 account, so you can trade differently. So size is, it's not considerations. You need to manage your risk, how much money you're willing to lose and how much you have gained so far. So AMAT dropped 54% gain. Disney So I had October calls and September. September is losing money. So when September was losing money and Disney was coming up with the earning, so I don't want to buy September calls and on top of September I have. So I initiated with the October calls. So October calls I close it with gains on earning. So when the earning came after market hours, Disney first fell and then it reversed to the upside. They're raising the price. So during regular hours when the market opened, I closed the October. This is another trade on FSLR. I think this is another trade on FSLR calls. This is the reversal I'm talking about, the gap down reversal. So EXPE gap down, and then when the gap down occurs, there is no follow through. It gapped up. So gap down is here, but you see this is a gap up. So gap down occurred and it closed at 97 level, 97.50, but then it gapped up. So when it gapped up, it's a pregnant, it's called something named pregnant. So it's like a pregnant pattern. So when this kind of a pregnant pattern appears after the gap down and this, it tells you that the sentiment, somebody wants to buy, but I did not want to initiate a position on the same day. So I waited for the next day confirmation. So when the next day confirmation happened, I initiated trade calls and I closed it at the 50-day resistance, 45% gain. J&J, right now I have a J&J short position. So J&J, I went long and I close it at 173. Now I have a short position. So same trade one day. If you're a swing trader, you have a short position, then you have a long position. You have a long, you have a short position. So you're doing it what is happening. So now I have a J&J short position. I close this long position. I entered here and close here. DQ energy stocks were moving along with other stocks. 30% gain here. Run. So we bought run puts, and this is what happened on a downfall, 81% gain. Now I have a run on the call side, which is losing money right now. So 81% gain on a pullback. So what run did, you see this reversal happen. So what are the chances that on the pullback, on a sharp reversal at 22, that it will next day it will go up? It tanked. When it tanked, I closed it next day. So entered here, closed here. Team, I entered team and the earning was coming. I entered team here and it gap, I closed. So this gap is huge gap. I close very like within 30 minutes. Send the alert to the member. So I send the alert. My team is prepared to send you the alert during the pre-market hour. So we watching the pre-market action and sending you the alert that this is the strategy. If we have to adjust the targets, we adjust the targets and send you the alert that the team will gap up. And during 15 minutes, first 15 minutes, if team doesn't do this or does not maintain this price above, then you need to close your trade and lock your gain. So team, we lock the gains here. I don't know where the team is right now, but this gap is an opportunity to close the position. If you're already in the position, do not add to or initiate a new position. T-dog. So what are the chances when the T-dog you capture at the initial move and then it goes up like this? What are the chances that the T-dog will pull back? So, I mean, it can pull back, it did, but it did, I closed, and it rested on, I don't know what team the T-dog is doing right now, but when it closed, it started to pull back, we exited because we don't know where the T-dog will come. Maybe it will pull back to 27, 26 level. I don't know where it is right now, but close next day. G, so here you don't see anything. So you say, where is the entry? You know, G is doing like this. Where is the entry? I must have seen something. We were on a gap up next day on the earning. I think the earning came and we closed right away on the gap. Ask question later, shoot first. Here is the Baidu trade. So when the Baidu is moving, so something was going on with the Baidu and the volume was nice. And the same day, I think we entered and closed in the same day with a 52% gain. Here is CVX. So I trade oil stocks, CVX, XOM, what else? COP. So I have a long position on COP. So CVX entered here along with all the other stocks were moving, oil stocks were moving. There must be some news or oil is moving up, entered here. And next day when it gapped up, 56% gain, close it. Don't need to wait for another day. MS, another example. So now all the bank stocks. So bank stocks were moving up. Now bank stocks are getting clobbered. Here's a Google. Now I think I have a short position in Google. So Google, I entered here, it went against me, but then it gapped up to the resistance and I closed it. Now I have a short position on Google. AMD, this is a AMD trade. AFRM, this is AFRM trade. This is GLNG entered here. There must be some reasons of break of the resistance and I close at 44% gain. Twilio entry here, break to the resistance, close it. So this is a resistance level, 69.70. The Starbucks, I closed on a gap up. When the gap up occurs and the twinkle, twinkle, little star is forming, it's time to close the trade because there's no follow through. So entry was here, earning came and then gapped up, but the gap occurred with the tiny candle. So there's no reason. I don't know where it will go. The gap occurred and there's nothing. So I need to close and lock the gain. So 31% gain. PayPal, same, entered here and exited after 3-4 days move. Now the PayPal is coming down. I'm on the looking for the short side. LNG again is another example of a long trade. Airbnb, so Airbnb entered here, exited on the next day when the red candle form after a big up day move. The next day is creating a red candle and I have a 50% gain. I would exit from the trade. Beyond Meat, same phenomena, 33% gain. Riot, this is a Riot long trade. On the other side, there was a Riot short trade. This is a long trade. So I entered on the long call, and after 2 days, on the next 2 days move, I exited with a 33% gain. FCX, only 14% gain because it gapped down. I entered and it gapped down and it stayed at the 50-day, 200-day moving average. So I closed the FCX put trade at a 14% gain because I don't know, it will break 200-day moving average or will it stay at the 200-day moving average. So I took the 14% gain and I closed it. Again, another last one is JWN when it was breaking above. So when JWN is moving up, there must be some other retail stock. So I don't know what happened that day. Maybe there were some other retail stocks which were moving in the same category as JWN, like KSS, ROST, Burlington, etc. So I entered long, and then after 4 days later, I closed it at 78% gain. So what was happening at that time? I don't know. All right. So yeah, we send out email and phone text, SMS, but the emails are as fast as SMS. There's no difference. If you have a Gmail on your iPhone, it will come right at the time when the text alert comes. There is no difference. We have a dedicated server for sending you the trade alert. We don't send anything except the trade alert from that server. We have SMS, and we are setting up Telegram and other channels if you are interested in it. But email is as good as text alert, instant delivery. All alerts which we send out, we also receive in our inbox. So we know the delivery. If there's any time there's a delay, we immediately look at it. So we continuously monitor during the market hours. We are watching the trade alert for the delivery. If there is any delay, we send out. Sometimes you receive 2-3 alerts at the same time because we think there is a delay. So we send you the same alert again after 30 seconds. If it doesn't deliver, we send you. It's not like we are not day traders, so you don't need to worry too much that I need to have. So if you have an app on the phone, Gmail is fine. It just pops up right away. All right, so I am going to stop here. What I realized that I'm not getting. Ruben, you need to talk to send the email to. You're always having some problem. So I believe that if somebody is having a problem, constantly having a problem, then something is wrong. Maybe you're too busy. So for trade alert, don't um, don't get the alert the email which is your work email, and then you're getting all your emails from your auntie and uncle and everybody, and our trade alerts are there. Have You're in a trading, it's a serious business. So for serious business, serious thing needs to be employed. So have a dedicated email. You can have multiple emails on your phone, but have a dedicated email, and nothing comes. Let's say you're serious, nothing comes except our trade. So if anything is there, its inbox is there. We send out all the alerts for the sell targets, etc. And when it's closing, we have defined a matrix. It's a very complicated matrix, so multiple exits. We have a criteria where we set that whether we need to close trade completely or half or majority or one third. So it depends on what the trade is doing. So based on how many days we are in the trade, what is the expiry, how many open position we have, what is the market condition, what is the resistance level if we are in the long side, how far is the resistance, do we have, is there any event coming up, earning event, FOMC, this, that, whatever it is. So we take into consideration all of that, and then we send you the alert, selling half, selling majority, selling blah, 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 all this. I'll show you what we send, give you the example since you're here. So opening. So I'm sharing again, just a second. So So let me go back. So there's a price and volume filter. So we deploy price and volume. So I have a team, a lot of people behind me. Before I was just on my own, little guy sitting in with the laptop among 50 colleagues and opening and trading Joe. Now I have a team. So there's a team in the background working and doing the thing which I tell them to do, and they're master in doing things. So there's a price and volume filters. So we have deployed price and volume filters. I have prepared a separate presentation on the filters. So I will explain to you in different presentation in detail about the different filters we deploy. Not only the technical filters, not only the fundamental filter, but there are psychological filters which we traders use knowingly, unknowingly. They are successful or not successful because of some psychological filters. So I will explain to you all those psychological filters in a separate presentation I have prepared, and I will show you. So then your trading will improve. So these are some of the filters I deploy: price and volume filters. The price is this much is going up, it changed this much in this time range. So let me look at it, or the volume has changed, or is it above, trading above average true range, or it's 80% of the true range has completed. So if a stock trades at, let's say, $3 on average, and it has covered $2 in the first hour, so something is going on. And normally it trades $3, and it has covered $2 already in 1 hour. So something is there, and the volume is there, or something else is going on which merits my attention. So we need to look at it. So um, I tell my team. So there's a team behind me, and I am communicating and I'm trading with them. So there are people helping me behind. Previously, before I was doing things. So I delegated the tasks. So you can say I delegated a lot of tasks to my team members. So these are some of the filters, and I will explain to you in more detail in some other time. So volume filters and price filters. This is the example of a trade I send you on via SMS or email. So on a subject line, only say a short and sweet Meta call September 310 buying to open at $10. So details are in the subject. If you have SMS, or you don't need, your email pops up and it shows on the subject line. So you execute the trade. You don't have to hurry up and buy right away. It's not like super fast. I'm not a momentum trader, so the price stays the same. I'm monitoring the price levels when I send you the trade. I'm monitoring it if it's there or not. So it's not like it's changed. So you set your limit order and you buy. If it doesn't get filled, you cancel it and you buy later. This is the guide for to chase or not to chase. So depending on where it is, you can pay extra price. If you're trading Tesla, then maybe you can pay 40-50 cents extra because you're going to make more money. So don't haggle over 5-10 cents or 20 cents, depending on the option price. So don't chase it, buy less if you have to, and then buy more later. Cancel your buy order. Don't leave it your buy order forever. Is only valid for for that day. It's not like you leave it forever, buy order, and cash the falling knife. The option price change very quickly during trading hours. So during trading hours, option price changing quickly. There's something is happening in that option. So you have to understand. Expiry date is a third Friday. So if it's not a third Friday, then we mention in it to you that this is not the third Friday, this is something else. Otherwise, by default, it's third Friday because we trade monthly option. So third Friday. Then we send you the trade target. So when before even executing, sending you the buy alert, already define the target. So the price targets are already known. So all that what I explained to you goes in understanding where the targets are. So then we send you the trade targets. We define the trade targets as green, yellow, and red. So based on the traffic signal, this is a 10-year ago uh, when I was trying to communicate to my members. So I had first, second, and third. Then I said, how about I define the targets in the traffic signal? Even my little son knows that he need to stop when he see yellow. Daddy shouldn't be crossing the yellow signal. So he tell me, Daddy, you cross the yellow signal. So I know my son. So green target is defined as if it's a minor resistance and it will hit, probability is high, and then the stock will continue. If it's hitting the yellow, the way the yellow target is defined is some kind of a pivot, some kind of a resistance for calls. So we know that the stock will take some breather. And the red target is the ultimate red target, is ultimate resistance. So if it's a long ultimate resistance, so we define the red target below that ultimate resistance, some cushion. Is not exact resistance, because if the resistance is at 199, then the red target is like 197.50, not 199, not trying to squeeze the last penny. So some level below, and then if it's hitting and it's crossing, remember the magic carpet, if it's crossing, then we revise the red target and send you the target and say, okay, the red target is revised, please hold or sell half. So things like that. So the green target have a high probability of hitting. It's like going from San Diego to LA. So I have a pretty good chance of when I start driving in San Diego, I will reach LA, maybe I will reach Santa Barbara, but I don't know when I will go reach San Francisco. Maybe I go to Big Sur, or I go on a scenic route. Instead of one day, I arrive 5 days. So that is the concept of yellow target. And I really don't know when I will arrive in Seattle. So there's the concept of a red target. So I know I will reach to Seattle, but I'm not sure when. It will take time. So that's the concept of red target. So there's the ultimate. But if the sometime, especially on a downside, so the market falls faster and rise slower. So especially if we are trading puts, the red target may be revised more often than in the call trade, because the stock rise slowly, falls faster. So that's why I like trading to the short downside. Although the long-term portfolio is getting clobbered, such as IRA or whatever it is, but on the other side, making money. So the yellow target is like going from San Diego to Santa Barbara. The red target is like going from San Diego to Seattle. So it has a chance of reaching, but it will take time. So we send you different trade alerts. So we have defined multiple exits, and it get triggered, and we get the alert whether we send you the message of selling half or whatever it is. So we know what we have sent you before, and based on that, we send you the next trade alert based on that. And we also know during the pre-market hours, all the positions are evaluated. Whatever we have, we evaluate, and any action going on in any open position, then we send you the alert either to sell or hold or revise the target, etc. So all that analysis goes on Revised targets, red target if it's revised, we send you the revised targets to capture more gains. And the targets are revised for the calls to the upside, and sometimes it gets shrink. So the targets can be adjusted to the downside. So things happen, the stock doesn't want to move. So we revise it to the downside and send you the alert that this is the target now and we need to close the trade. So all that goes on during the market hours. So we send you the trade selling 1/3, sell half, sell majority, whatever it is. So depending on your portfolio size, depending on how many contracts you have, you sell 2 or 3, or if you have one, you sell one, maybe at yellow target. So all that, we evaluate the pre-market strategy. We send you the trade alerts during pre-market hours. If we have to, we see that, and we watch the high and low in the market during the pre-market hours, and you need to watch it too. If you are trading on your own, you need to watch the pre-market levels or after hours, the highs and the lows. So all that goes on. We do send you the alert to buy more if we have to average down. We send you the alert based on the support and resistance I talked to you, explained to you. Sometimes we send you the alert to buy more even at the high price. If we are in the trade and if it's trading at the high price and we know the new members have joined, so we send the alert for them, because we still believe that even if they buy at the higher price, they will be profitable. So they need to buy this. So we don't want to miss them to miss. So we send that alert. Sometimes we have a position in next 1 month and we buy another month because we want to spread our risk. So we say, okay, this trade is looking good. We have a position in this month, but we're going to open another position, another strike in another month. So all that goes on. You can even create a vertical spread when the target hit. You can deploy by selling. If you have a margin account, you can sell the short calls. So you lock your gains and create a vertical spread. So all that you can do. We send you the alert on the volume update, etc. If we see something is going on, I send you the alert. Sometimes I get carried away and send you many alerts. And when we are ready to take the trade, lock the gain, we send you the alert. And if you have to buy more, we send you the alert to buy more. And this last thing is setting the conditional order. So conditional order is a separate topic. I have taught that before and I'm revising it. I'll teach you more about conditional order. So conditional order is also called activation rule. So you can set your order to sell option based on some conditions. So that condition could be anything. It could be NASDAQ hitting this price, S&P hitting that, or BABA. You are in a BABA, let's say you're in a BABA call, and you can set the condition that sell my BABA option when Baidu hit this, or sell BABA contracts when Apple hit this. So you or sell my BABA calls when BABA hit this target. So you can do all this kind of a conditional order to protect your profit, to protect your set stop loss, or set any conditions, or set, there are many kinds of conditional orders. So it's a different topic. So I stop right here, and tomorrow, not tomorrow. So tomorrow is the market, open. What is your list of stocks monitored? So there are 250 as a core, and then there are 500 plus stocks. So I suggest you prepare your list of stocks. So do some homework during market hours. Start monitoring. Best way maybe just go some trading platform and see the top-notch stocks like Apple, Baba, Baidu. You start from there. You create your own list. Do some homework. So when you do your homework and prepare your list, then you are familiar with